Sanjay Mookim is now joining us. He's a head of India equity research at JPMorgan. Sanjay, good morning. Great to have you with us here in the program. Thanks very much for joining us. I don't know if you heard our External Affairs Minister, S. Shankar, at that conference in Delhi, talking about India-U.S., essentially basically saying that we are yet to find common ground for talks to take place with regards to resolving these issues. So I'm just sort of summarizing this in one line. So it does give you a sense of where we are at. If this is an issue, an impediment for the market, sentiment-wise or otherwise, the minister essentially saying we are perhaps still in very early stages, trying to establish the broad framework on the basis of which we have to agree what we are going to talk about in that sense. That's what it seems to me. Sanjay, how do you see this and implications for markets?
Morning, great to be on. I think, look, you can't deny that it is an overhang for markets. What degree of an impact the lack of an India-U.S. trade deal is very difficult to assess, of course. But what I'd also suggest, is that, look, other markets around the world are doing very well for intrinsic reasons. So the tech rally everywhere, the rebound in China, the rebound in Korea. So yes, maybe let's say an India-U.S. deal could alleviate some of the pressures on the Indian equity market, and you may see a bounce on the announcement of one. But it may not necessarily be redemption for the underperformance that we have seen so far for MSCI India. You need a little bit more bottom-up push, I expect, for this underperformance to close.
Sanjay, hi. Great to have you with us this morning. So much going on. We are running into yet another earnings season. And, if we just go away from the global noise and what the U.S. administration is doing or isn't doing, at the end of it, it boils down to earnings, right? And that is where we are yet to see any sort of a meaningful pickup. Now, are we at an inflection point where that changes because of all the policy stimulus, GST cuts, RBI, etc.?
Good morning, Surabhi. I think we could be at one. And this was one of the themes at our conference that we recently concluded. And, I was worried that participation might be soft given that markets been flat. But there was a big vote of confidence. A lot of people showed up. And one of the things that everybody was trying to explore was this. There has been a lot of, let's say, stimulus affected through the tax cuts, the GST rationalization, of course, combined with the rate cuts that you've seen. And this could lead to a revival of consumer expectations. Now, this is not likely to show up in numbers for the September quarter because the cuts happened very late, of course. But I think the results season this time around, there will be a lot of focus on how companies talk about the upcoming quarters. Have they seen a change in inflection? Have they seen a change in consumer trends? And therefore, there is this possibility that you get a little bit of momentum in earnings, especially given that we've already cut our numbers quite a bit in the last few months.
All right. Hi, Sanjay. Good to see you. And as always, what about the FI behavior? What are they thinking with regard to India? We used to be a darling till, 12 to 18 months ago. And that selling has been relentless. Though, thanking our stars in the last week or so, that cooled off a little bit. But they continue to remain net sellers. Their holding in the Indian markets is at a multi-year low. And in the FNO market as well, they're net short. Do you think that there are signs that gradually at these valuations, with the kind of measures taken both on the fisc as well as on the monetary side, and the hope that earnings come back, the FIs gradually start piling on the Indian stocks yet again? Or do you think that still has some time?
We'll see how these are very difficult things to anticipate in the short term, of course. See, India, everybody agrees, has a lot of potential in the long term or the medium term, right? There's all the known tailwinds of continued urbanization, the manufacturing drive that the government's pushing, urbanization, that's likely, the demographics that everybody agrees to. So those factors sustain, and India therefore remains a place of inquiry for everybody for the long term. I think the challenge, at least in the near term, is the fact, like I was saying earlier, that other markets have delivered much sharper bounces. There's greater clarity on many others, let's say tech-related sectors, of course. And a lot of investors were not necessarily positioned to participate in those rallies early on. And therefore, you see continued rotation out of India, which had been owned by them for a while, into these newer momentum areas. So until you see that reverse, the relative argument reverse, I'm not sure you're going to see too much of FI flow come back just because the markets underperform.
So Sanjay, what you're saying is it has to be someone else's loss for the market here to do do well. So let me explain. I don't mean it literally. Basically, from what I understand, what you're saying is money is going into themes like artificial intelligence, infra build out there, etc. You don't have very much here to as plays on that. So at some point that reverses, and then people start to sort of look at other areas. Right now, it's all concentrated in one big theme globally. Is that what you're saying?
It's not just one. There's let's say the stimulus in China, the rebound in Korea that you saw as well. The tech being just an example that I was using, Prashant. So I'd argue that, look, equity investing is a relative game. And if you have greater confidence of earnings momentum, and let me just highlight this one point. EPS expectations for the S&P in the near term are actually being upgraded. Right now, you can debate why it is happening. It's only tech-driven, or that you had cut them too much after the Liberation Day tariffs, etc. But nevertheless, for equity investors, you're seeing upgrades in the S&P EPS number. How sustainable they are, we can all debate. But in India, we have not seen that earnings momentum as well. So you need to start to, let's say, catch up on those trends, deliver some bottom-up momentum before you can claim some interest from foreign investors.
Sanjay, on that point, I know it's a little out of subject for us sitting here talking about India stocks and India earnings, but since you have that worldview as well, and you met so many people at the conference, there is some chatter that's starting about whether global markets, starting with the US itself, is now, in the build-up to a bubble stage. And I read some stuff over the weekend as well. I mean, private credit in Europe has gone all over the place, and there was a bankruptcy over the weekend, and then there was some, murmur of, we all remember how we got to that point of 2008, right? So I'm not saying this is anything similar, but is that a concern? Because then all bets are off, right? I mean, if we are at that point in global markets where perhaps there's a bigger correction coming. I mean, look at what's happening to gold. It's just going up, and central banks are buying, not just speculators. So just your views.
Well, this can be a very long discussion, of course, Surabhi. But look, Archie suggested that the markets or economies seem to be in some sort of bubble stage. Whether we are mid-cycle or late cycle is extremely difficult to pinpoint. But there are excesses, clearly. The only saving grace, I'd argue, is that corporate balance sheets nowhere seem to be very leveraged. So unlike, let's say, 2008, as you referred, there doesn't seem to be a leverage problem in the corporate sector, but possibly a leverage problem in the government sector, where governments have borrowed, debt to GDP has gone up materially. And consequences of those might actually filter through into economies. But we don't expect, at least personally, I wouldn't expect much of a corporate sector blow up, because there isn't much leverage in the system.
Yeah, that's good to hear, and good to have that reminder, so we don't have to get too worried. So which brings us back down to, how people should look at their India portfolio. I mean, and there's this other debate, capex versus consumption, saying now, do you need to unload a bit on capex and move some of that money to some part of consumer? And where are you on that? And within consumer, where should the focus be? Because it's a very large basket overall, consumption.
In the near term, I think the answer is very, very evident, Sulpi, that the stimulus that the government has affected, I mean, we should hesitate in calling it a stimulus. It's a shift in policy preference, if you will, because the fiscal deficit will remain at, I would expect, 4.4. You're just taking, some money I expect from capex-related spends to the tax cuts that have gone through. And combined with the rate cuts, there is enough of a momentum for mid-income households to reconsider their purchasing decisions, right? There is that consumer stimulus. So looking at more consumer-related stocks in the near term makes a lot of sense. Now, the challenge, of course, investors face is many of the stocks have already gone up. So the question is, where is it not priced? Where are further surprises likely? And we would argue that where there is elasticity to the price cuts that have come through is where we would continue to look at. So maybe some of the auto-related names make sense. The discretionary, obviously, you'll have greater elasticity to price cuts than staples. So those are the sectors where, I would agree with the consumer over capex in the near term, but more discretionary over than staples.
Yeah, and that's been your call, Sanjay, for earlier this year as well, I recall. And that call actually has gone very well, because staples have still not picked up. The growth is extremely anemic. And with this GST 2.0 boost, discretionary could get a further boost. That said, how are you feeling about the markets? You're sounding a little bit somber still, and earnings have not yet picked up. If earnings don't pick up to the extent possible, a lot of newbies in the market, they are frustrated last 12 to 15 months. In fact, the index itself is lower. Do you think we could brace for a couple of years or maybe single-digit returns itself on the index, and that would be a good case outcome?
I would lean towards that. Now, the issue, of course, is that the higher multiple that you buy it, and this chart is clear over the last 20 years, the higher the entry multiple, the lower the future returns. Right? These are very self-evident, I think, pronouncements. And so, if you do buy equity assets at current valuations, your expectation of future returns cannot be in the double digits on the index ETF. Let's say. If you are able to, let's say, buy stocks and some of them deliver returns, that's separate. But on an index ETF, you should not expect very high returns if you're buying at current multiples. On your first question, of course, Nigel, is on what we think of the markets. Look, it looks like you could see a little bit of a bounce because, like I said, expectations have been right-sized, earnings have been cut. Valuations for the Nifty are at 10% on discount to the S&P 500. And India tends to track the S&P multiples reasonably well. Plus, of course, we have this hope that December's March quarters turn out better for the consumer-facing stocks in the economy. So I wouldn't get too negative on the index itself. In fact, I would argue that there's probability of a little bit of a bounce in the near term.
Yeah, no, absolutely.